Every day, we spend a couple of dollars without even thinking about it. A quick coffee, a snack, a random charge we forget by tomorrow. But what if I told you that the same $2 a day or less, let's say $12 a week, could turn into an income that pays you every single month? Sounds impossible, I know, but that's exactly what we'll do in this video. I'm going to walk you through a strategy that makes it possible, starting with just $12 a week. I'll show you how dividends turn ownership into income, how compounding multiplies your returns, and how a handful of carefully chosen stocks can create real long-term cash flow. I'll show you how to avoid common dividend traps that keep people broke. And in the end, I'll show you how this exact strategy and the selected portfolio can grow $12 a week into a $500,000 portfolio that pays over $4,000 a month in passive dividend income, all from the cost of one lunch a week. Before we get into the actual stocks though, let's take a quick step back because everything in this strategy starts with one simple idea: dividends. Now, a dividend is just a small part of a company's profits that it shares with its investors, people like you and John who own a piece of that company. Not every company pays them, but the ones who do usually have strong, steady businesses that make money year after year. Here's how it works. When you buy shares of a dividend-paying company, you're basically signing up to receive a small payment for each share you own. So if a company pays $1 per share and you own 100 shares, you'll get $100 in dividends. Most companies send these payments every 3 months, though some do it monthly or once a year. The size of that payment depends on something called the dividend yield, which is just a fancy way of saying how much you earn in dividends compared to the price of the stock. For example, if a stock costs $100 and pays $4 a year in dividends, that's a 4% yield. What makes dividends powerful is that they pay you without forcing you to sell your shares. Your money keeps working for you, earning more shares as the stock's value grows while also paying you cash in the meantime. And as companies grow their profits, they often raise those payments too. That increase over time is called dividend growth, and it's one of the strongest drivers behind long-term wealth. This steady income combined with long-term growth is why dividend-paying companies are so attractive to investors focused on building passive income. But there's one small choice that makes a huge difference in how fast that income grows, and it's what separates slow, steady returns from life-changing ones. When you start earning dividends, you'll face a simple question. Do you take those dividends as cash or do you reinvest them? These are the two main approaches. One is called non-DRIP, where you simply collect the dividend payouts as cash, and the other is DRIP, which stands for Dividend Reinvestment Plan. Let's break down what that actually means. With the non-DRIP method, your dividends go straight into your account. For example, say you invest $1,000 into a stock that pays a 5% dividend. That means you'll receive $50 after the first year. The next year, another $50. 3 years in, you've collected $150, nice and simple, but your original $1,000 hasn't really grown unless you add more money yourself. You're earning immediate income, but the growth stops there. Now, DRIP is slightly different. With a dividend reinvestment plan, those same $50 in dividends don't just sit in your account, they automatically buy more shares of the same stock. Using that same example, your $50 at the end of year 1 buys half a new share if the stock still costs $100. Now you own 10.5 shares instead of 10. In year 2, your dividends are calculated on 10.5 shares instead of 10, which gives you about $52.50. That gets reinvested again, buying even more shares. By year 3, you're earning roughly $55 in dividends and now own about 11 shares. You didn't add a single extra dollar. Your dividends did all of the work for you. Now let's compare those two side by side. With non-DRIP, your $1,000 earns $150 in total dividends after 3 years, but your investment stays at $1,000. With DRIP, the Dividend Reinvestment Plan, those reinvested dividends grow your total to around $1,157. You made more money without lifting a finger. Not to mention, you'd have earned $157.25 in total dividends. That's the strength of compounding. Your dividends buy more shares, those shares create more dividends, and the cycle keeps repeating. It's like planting a tree that keeps dropping seeds. Each one grows into another tree that produces even more. Over time, your dividend forest multiplies on its own. What starts slow becomes exponential, especially if you're investing in companies that raise their dividends every year. That growth rate is measured by something called CAGR, or Compound Annual Growth Rate. It's a fancy term, but all it really means is your income grows faster every single year. The difference between taking your dividends and reinvesting them might seem tiny in the beginning, but give it 10, 20, or 30 years and it is massive. But before we start talking numbers and stocks, it's just as important to know what not to do, because a few simple mistakes can quietly slow your growth for years. The first big mistake many investors make is chasing high dividend yields. Look, I get it. Seeing a stock paying 8% or 10% looks exciting. It feels like free money, but in many cases, that's actually a warning sign. When a company's dividend is unusually high, it can mean the stock price has dropped or the payout isn't sustainable. And when profits fall, those companies usually cut their dividends, which means your income drops and the stock price tanks. That's what's known as a dividend trap. The next mistake is ignoring the payout ratio, basically how much of a company's profits are being used to pay dividends. A healthy payout ratio means the company keeps enough of its earnings to reinvest in growth and protect the dividend during tough times. But if that ratio is too high, the dividend might not last. You always want to see balance, a company that rewards shareholders while still leaving itself enough room to grow. Another mistake is putting all your eggs in one basket. If all your dividend income comes from a single stock or even a single industry, one bad quarter can wreck your entire plan. That's why diversification matters so much. Spreading your investments across multiple sectors helps smooth out the bumps and keeps your income steady when one area struggles. And finally, there's one mistake that often slips under the radar, and that is taxes. Dividends usually count as taxable income, which means a portion of what you earn might go straight to the IRS. The exact amount depends on where you live and your tax bracket, but it's something worth planning for early. A smart way to handle this is by using tax-advantaged accounts, things like a Roth IRA or a 401k. When you invest through one of these, your dividends can grow and compound without being taxed every year. With a Roth IRA, for example, you invest money you've already paid taxes on, and then all the growth, including your dividends, comes out completely tax-free in retirement. That's a huge advantage because you get to keep every dollar your portfolio earns. The good news is, once you know these traps and how to plan around them, you're already miles ahead of most investors. Next, I'll show you how to select stocks, and in the end, I'll show you how the selected portfolio can grow $12 a week into a $500,000 portfolio that pays over $4,000 a month in passive dividend income. But first, here's how to create a stock selection criterion for your portfolio. See, picking the best dividend companies isn't about chasing the highest yields or the trendiest names, it's about balance, finding stocks that give you solid income today and the kind of growth that keeps income climbing in the future. Let's start with dividend yield. That's the percentage of a company's stock price that it pays you back each year. A good yield gives you steady income, but if it's too high, that can be a warning sign. The sweet spot for most healthy companies is usually somewhere between 2 and 5%. That range keeps the dividend sustainable while leaving room for future growth. Then there's dividend growth, and this one's huge. When a company raises its dividend year after year, it's basically giving you a pay raise without you having to do anything. We measure that using something called CAGR, which just tracks how fast those payments have been increasing over time. The more consistent the growth, the stronger the company's long-term commitment to rewarding its shareholders. Next, you want to look at financial strength. The most reliable dividend payers are companies that generate steady profits, have manageable debt, and strong cash flow. Those are the businesses that can keep paying and even growing dividends even when the economy hits a rough patch. And while we already talked about diversification earlier, it's worth thinking about it now in terms of balance. You want a mix of sectors, maybe a solid utility, a reliable industrial, a bit of tech, and some financial exposure. That way, no single industry controls your income stream. Finally, think about total return, not just dividends. Some companies might have a modest yield but grow fast enough that your overall gains end up much higher over time. It's that blend of steady income and long-term appreciation that really builds wealth. So when you combine all of these, a healthy yield, consistent growth, strong balance sheets, and good diversification, you get a portfolio that doesn't just pay you now, but continues to grow with you. Now let's put all of that into action. Here are the 5 dividend stocks that fit perfectly into this $12 a week strategy, each one chosen for its balance of income, stability, and long-term potential. Each of them is chosen for a balance of dividend yield, growth potential, and long-term stability. Let's start with the foundation of the portfolio, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. This one gives you instant diversification across many high-quality dividend-paying companies. It yields 3.76%, has a 10.43% dividend growth rate, and has grown about 8.26% per year in price. Next up is NetEase, ticker symbol NTES. NetEase is a major Chinese tech company known for its role in gaming and e-commerce. It has a lower yield at 1.89%, but what really stands out is its incredible 24.82% dividend growth rate and 19.36% annual appreciation. NetEase brings high growth to the portfolio. It's the part that keeps your overall returns moving upward even as your income compounds. The third stock is Morgan Stanley, ticker MS, one of the strongest and most respected financial firms in the world. Its dividend yield is 2.58%, but its 22.4% dividend CAGR over the past decade is exceptional. Combined with 17.18% annual price growth, Morgan Stanley offers a mix of consistent dividend increases and strong long-term appreciation, a true growth with stability pick. Then we have CubeSmart, ticker symbol CUBE, a real estate investment trust focused on self-storage. What makes storage such a strong business is that people need it in both good and bad times. That reliability shows up in CubeSmart's numbers: a 5.17% dividend yield, a 12.51% dividend growth rate, and 3.8% price appreciation. Cube gives your portfolio a dependable income base you can count on no matter what the market's doing. And finally, we have Illinois Tool Works, ticker symbol ITW, a diversified industrial company that's been around for over a century. It has a 2.47% dividend yield, 11.79% dividend growth, and 11.75% annual appreciation. ITW represents the steady, compounding core of your portfolio. Not flashy, but consistent and dependable over time. When you combine all 5 of these, SCHD for diversification, NTES for high growth, Morgan Stanley for financial strength, CubeSmart for income stability, and Illinois Tool Works for long-term compounding, you get a portfolio that covers every base. This mix of yield, dividend growth, and appreciation is what allows a small weekly contribution to snowball into thousands in monthly income over time. So the next step in this process is to calculate the portfolio dividend yield, basically how much income your entire group of stocks pays on average. The simplest way to do this is by using a very simple average formula, since each of the 5 stocks gets an equal amount of your $12 a week contribution. Here's how it works. Start by listing the dividend yields for each stock. SCHD pays 3.76%, NTES pays 1.89%, MS pays 2.58%, Cube pays 5.17%, and ITW pays 2.47%. Next, add them all together. 3.76 plus 1.89 plus 2.58 plus 5.17 plus 2.47 equals 15.87. Then divide that total by the number of stocks, which is 5. So 15.87 divided by 5 equals 3.17%. That means your overall portfolio dividend yield is 3.17%. In simple terms, for every $100 you invest across these 5 stocks, you can expect to earn around $3.17 in dividends each year, before factoring in dividend growth or reinvestment. Now, you can use the same simple average formula to find your portfolio's dividend growth rate and annual share price appreciation as well. Using the same 5 stocks, the average dividend growth rate comes to 16.39%, and the average annual share price appreciation is 12.07%. So what does all of this actually look like if John sticks with $12 a week? Well, let's walk through it step by step. John is investing $12 a week, which adds up to $624 a year, which would be his balance after 1 year. After 5 years, John's portfolio will be valued at around $4,263. Fast forward 10 years, and his portfolio is projected to grow to about $13,423. By year 20, his portfolio is expected to be worth around $85,006, and then he starts seeing serious traction. His money will be working harder than he is, and the growth will be accelerating all on its own. By year 30, this simple $12 a week routine is projected to turn into a portfolio valued at roughly $593,068. Now let's look at the part that really matters here, the income. At the 30-year mark, John's portfolio will generate about $52,167 in annual dividends, or roughly $4,347 every month. That will be a second salary, completely passive, built entirely from a $12 a week contribution. And here's what will be happening behind those numbers. Out of that final total, about $327,935 will come from capital appreciation, the stocks growing in value. Another $246,413 will come directly from reinvested dividends, money that keeps making more money over and over again. Altogether, that's $574,348 in added value created purely through compounding. And from John's pocket, over the 30 years, he would have only invested $18,720 to make it all work. Want to know the fastest way and the investment amount you need to reach $3,300 a month in dividends? Click the video on the screen to find out.